6th one. We've been putting them together fast. What we're trying to do is just be responsive to our members in the community on whatever topics you want to know more information about, what's important, what's hot right now. And we've been trying to go out and find resources and experts to talk to us, kind of give us some tips and kind of let their perspective on what the issue is or the hot topic of the moment. So today we had one of our members kind of bring up the issue of what happens to our regional economy after the pandemic and what does that look like. And there's been a lot of kind of negativity and sadness about everything, but really once this is all behind us, there could be an opportunity for the Midwest and specifically our region. And we thought that was such an interesting and really positive topic that we reached out to a few of our sponsors to see who we would have to speak on this, and some alums, some members, and we have a great panel today. Before I get to that, though, I'll let you know, if you haven't been on one of our webinars before, what we do that typically works best is if you could mute yourself if you're not speaking, that helps with the background noise. And if you have any questions, I'm going to give each of our panelists a few minutes to kind of talk about their area of expertise, give an update on what's going on. If you have questions, you can use the chat feature. If you kind of hover over at the bottom of your screen, if you don't see your chat box, there's a chat icon at the bottom that you can click on. You can ask your question in there. You can ask it to everyone. You can ask it directly to me. I and Kirsten and Emily will monitor those, and we can ask for you. There's also if you hover over and click on participants, you should see your participants up in the right-hand corner. By your name, there's a raise my hand. If you have a question, you can raise your hand, and depending on if it's in-depth, I can call on you and you can unmute and ask, because we're hopeful that we get a good dialogue going, and that's really why we're here, is to whatever questions, ideas that you have on the topic, we want to have some good conversation on and be able to address. So I can either ask for you, or if it is more in-depth, I'll ask you to hop on video and unmute yourself and ask, okay? So with that, I mentioned our two panelists are Tom Jalics, he's an economist with Fifth Third Bank, who's been a sponsor of our center since 2009. And we also have Doug Rammel, who is we had a great conversation last week. He's a UT alum, and he's with Abstract Reality Ventures. So we are going to start with Tom, and with that, I'm going to pass it over to him.
Thank you very much, Angie. Good morning, everyone. Thanks for the invite. Delighted to be here. Wish we could do it in person, but I think that's probably for a later time and date. Hope everyone is staying healthy and safe out there and adjusting to the new normal. You know, I'm working from home, have been for about 6-7 weeks. My wife also has been working from home. We've got 3 kids, and you know, it's been challenging, but you know, we're adjusting, and I think after a couple of early days that were pretty rough, I think we've all kind of got into our groove. So, you know, that's what we do. We adapt and we adjust. So I'm the Chief Market Strategist at Fifth Third Bank at the Investment Management Group. That's just a fancy title. It really means I lead a group of investment professionals, and our job is to make kind of investment recommendations through our 5 main asset classes: stocks, bonds, cash, real assets, alternative investments. We kind of come meet monthly with this group of about 10, 12 investment professionals, and then we come to a consensus on where we want to kind of place bets, make recommendations, and these recommendations are then put forth by local investment professionals in market into our wealth management investment clients. So we typically look, you know, I'm not an economist technically, you know, maybe I play one in my day job, but really what we do is we look at the economy both domestically and globally to inform our decisions on the investment side. And I've got some slides here that I'll just kind of roll through, but the conversation is really where we are right now, where we think we're going to go, and then ultimately some, you know, some positives, some negatives that are going to likely come out of this kind of awful stretch that we're going through. So the title of the presentation is Nasty, Brutish, and Hopefully Short, and that's our expectations for what we're seeing from the shutdown in our economy. You know, from a markets perspective, financial markets perspective, this is a bear market, and it's the early part of a really, really sharp economic downturn, but we already know that. But I think it's important that you know, we acknowledge these facts and that we can start to develop a path forward for investors and for business owners. And we believe that, you know, the approach to the current market really should focus on these 3 considerations, if you can see them on my shared screen. One is that this current challenge is not unprecedented. I open up various financial publications. I look and watch CNBC and the various news outlets, and everyone says this is unprecedented. This is unprecedented. We respectfully disagree. We've been through much worse and survived, including a pandemic. And history provides lots of context and parameters around this situation, which we'll talk a little bit about going forward. We would just suggest investors and business owners have a balanced view. Weigh the negatives, and there are certainly a lot of negatives out there with some potential positives. In other words, the potential for better health outcomes as antiviral trials continue to proceed. And really for financial markets, for investors, if you have a 401k, if you have an IRA, really markets are forward looking. Eventually markets are going to look through all of the bad economic news that we're going to see, and we're starting to see really horrible, awful unemployment numbers that are going to persist for many months. But markets look through the woes of the present and really are trading off of the expected future. And that's a future which can potentially imply relatively strong growth. So the first consideration, again, really is that this current challenge is not unprecedented. Again, with all due respect to financial commentators out there, we've been through this before. It hasn't looked exactly like this, but we've been through massive drawdowns in financial markets, and we've got lots of historical experience with economic downturns driven by any number of factors, including a pandemic back in 1918, 1919. In terms of the magnitude kind of the challenge that lies before us, we don't believe that this is going to be as long or as negative as the downturn during the Great Depression or World War II, or even the Great Recession of 08 and 09. While a pandemic-driven downturn certainly has particular characteristics, we have precedent here too, and that would be that Spanish flu pandemic of 1918, 1919. That episode resulted in 675,000 deaths in the US and a population roughly the third of what we have today, and tens of millions abroad. Compared to that downturn, we don't think the present challenge is as great, as we are responding as a health community much faster. Medicine is better. Technology makes social separation less disruptive to the economy, and our government has added an unprecedented amount of fiscal and monetary stimulus to kind of counteract all of the worst case scenarios out there. Also, we should understand that the tighter the restrictions we have on kind of our economic restrictions today, the lower the long-term health costs and the long-term economic risks of this downturn. So what we're experiencing now, we really haven't seen in this country, but given the information at the time these decisions were made, it was the right thing to do to protect the population, to protect the most potentially affected members of our society. And the short-term pain that we're going to see economically, we do believe is going to be measured in weeks and potentially months, but not quarters and years. Most of the largest financial market drawdowns were associated with conditions that really just don't correspond to the current environment. You've had speculative stock market bubbles, you had financial panics, existential banking crises or oil supply shocks. And while valuations of the S&P 500 were really not cheap coming into the February market top, they were nowhere near the levels of dot-com bubble speculative excesses or the leveraged speculative frenzy of 1929. It just wasn't the same thing. And we're also very fortunate today that the banking system and its regulators largely learned many, many lessons coming out of 08, 09. And really the banking system today is on sound and solid footing. The widespread financial system and household leverage that played a big role in both kind of the Great Depression and the Great Recession really aren't present today. And that's a really good thing. And one of the key factors why we think this downturn that we're going to see is going to be brutish, but hopefully it's going to be relatively short. Again, we think it's going to be weeks and months and not quarters and years. The current downturn is unusual, however, and it came really at a time of significant positive momentum, not only in the US economy, but in the global economy. Most market drawdowns are associated with economic pullbacks that come after months of weakening economic conditions. And in this cycle, the global economy had actually been accelerating coming into the downturns that we saw late February and early March. While this strength is not going to eliminate the very painful economic period that we're living through right now, it does provide a little bit of cushion, if you can believe it. And more significantly, though, recessions are usually long, drawn-out affairs because it takes time to work through the major imbalances, whether it's an oversupply of housing and debt, in 2007 and 8, which is just the most recent example. We just don't have that today. So that's why we think this is going to be a brutal and hard downturn, but again, it's going to be relatively short-lived versus other big recessions that we've had in this country. I think our point number 2, or consideration number 2, is have a balanced view, and that's admittedly that's not easy, but that's what our gut is telling us to do today. As investors, it's really important to recognize the risk of succumbing to the emotionalism that is leading all the negative stories that we see on the financial publications each day. And there's no doubt that the markets face headline risks with the virus challenges that are going to be ongoing and with us for likely a relatively many quarters ahead of us. But investors, they're also quite right to factor in the significant economic deterioration that we're currently seeing, but you have to balance this against the positive. And remember that for every reaction, there is every action there is a reaction. What we've seen in this cycle, if you can see the slides, is an unprecedented amount of liquidity from the Federal Reserve. I'll show you a chart here in a second. Combined with the government, who has been at odds with each other on both sides of both parties over the last several years, coming together in extraordinary fashion to put money directly from a fiscal perspective into the hands of those most needed. So you've got monetary policy, which would be the Federal Reserve lowering interest rates to 0, buying bonds to keep credit markets functioning. Quantitative easing is the term that's used in financial press today. On top of that, you've got government officials on the fiscal side adding a little bit more than $2 trillion, which is more than 10% of our annual gross domestic product. It's an unbelievable amount of fiscal stimulus. So when you have the liquidity from the Federal Reserve, the insolvency risk is lessened because you have this fiscal stimulus behind us. You're putting dollars into people's paychecks who are going to be temporarily, we hope, we think, unemployed, and that's going to help that consumption machine to keep going. These are unbelievably important things that, again, to us at least, signal that we're looking at a shorter term, very hard, very deep recession. Coming out of the financial crisis in 08, 09, it really took about 7 or 8 years to get back to the levels of unemployment that we saw prior to the crisis. That is not our expectation today. We do think that we're going to see short-term unemployment. It's going to rise to the tune somewhere in the neighborhood of 15 to 20%, coming from about 3.6% prior to this, prior to the pandemic. But again, because the government acted quickly and very, very strongly, our expectation is that we're looking at weeks and months and not quarters and years, like we saw coming out of the Great Depression, like we saw years coming out of World War II, like we saw in the 1970 years of financial repression, like we saw in 2008, 2009 years of getting back to that full employment. We just don't think it's going to take that long because of these proactive actions that our government leaders have done so quickly. And then finally, kind of the third consideration that we're talking about is that markets, financial markets, and again, we're investors. That's what my job primarily is. Markets are forward-looking. They are digesting the information that's coming to us and trying to predict what the future conditions economically look like 12 to 24 months later. So markets really don't reflect what's happening right now. Again, they typically reflect what's happening in the expected future. And that's why we've had this massive run up off of the bottom in the third quarter or third week in March. We've had basically 28+% move in the S&P 500 off of the lows, intraday lows on March 23rd. And it really has a lot to do with the government's action, the stimulus, we believe, that was put forth so fast, so quickly, again, to hopefully stem the worst part of this recession that we're undoubtedly in right now, and make the economy stronger coming out at a future date. Again, weeks, quarters, not years later. You know, if this cycle followed the script of previous recoveries, the eventual market rebound is going to occur not necessarily amidst good news, but against really bad news. And I think that's what we've seen so far. So when the market is starting to already look behind the coming economic decline, you know, what might investors longer term expect future growth to look like? And I think that's, again, what some of the market conditions have given us over the last 3 or 4 weeks. Again, the short-term outlook will depend on how much damage is done to the consumer and corporate balance sheets, the workforce, and ultimately financial institutions. And from what we can see today is that all of these constituents are going to be hit hard, but it's continued our expectation that it's going to be relatively short-lived. And investors should remember that 0809 was somewhat of an anomaly. Deep recessions usually result in fast recoveries, and that's typically what happens. It's not what we saw in 0809. That was a recovery that was very slow coming off of the bottom because we had massive excesses in consumer indebtedness that took years to work off. And we're just not there today. This is a different kind of recession. Again, as I mentioned, we kind of came into this exogenous event, this virus-driven shutdown from a position of strength. And our expectation is once we have, we get past the worst of the virus and there are mitigants to protect us against the worst case scenarios when it comes to the health outcomes, you're going to start to see, as we are seeing now, the economies in the West, Europe and the US start to open up slowly and gradually, and that we're going to start to see some of that growth return. It's hard to see today because of what we're going to witness from an unemployment perspective, from a job loss perspective, and from a decline in output perspective over the next several weeks and months. But there is a future on the other side, and our government made this bridge with all of the monetary stimulus and all the fiscal stimulus to get over that hump. You know, investors are wise to remember an old adage called Stein's Law, which is if something cannot go on forever, it's going to stop. And this wisdom came from an American economist, Herbert Stein, back in the 30s. And it's really a good reality check when we have either investor pessimism or investor enthusiasm. The lockdown of much of the Western economies, both in Europe and the US, is not meant to be a long-term solution. It's slowing the spread of the virus through social distancing, and the resultant economic slowdown has brought time to build this strategy, increase hospital capacity, research antiviral treatments, and deploy support measures for the economically and medically most vulnerable. But it's not going to go on forever. And we're starting to see this now in the US. Impoverishing a nation really does not support good long-term health outcomes, obviously. And our policymakers know this. We should not extrapolate the near-term shutting down of the economic activity too far. And I think we're already starting to see this. In the coming weeks, Stein laws is absolutely going to come into play. And we don't yet know what combination of policies designed to protect the medically most vulnerable or expand healthcare resources or implement better case treatments will come into play to shorten the duration of the overall lockdown. But any discussion of policies to reopen the American economy will be a healthy one. And again, I think that's what we're seeing today. So why don't I stop there? We do have a glimpse of the future in the post-pandemic world. I think the biggest thing, you know, we've been talking amongst ourselves internally about who are the biggest winners and frankly, who are the biggest losers are going to be coming out of this. And the one thing we come back to over and over again is we think the reshoring of manufacturing, because of the supply chain questions that many business owners have had over the last 2 years, not just by the pandemic, but because of the trade issues that the US has engaged with China over the last several years. We think the reshoring of manufacturing is probably this big, big change that's going to happen. It's not going to happen overnight, but this is something that's really going to help the industrial Midwest, because this is where over the course of the last 25 years, most of the manufacturing economy and jobs have been lost. But make no mistake about it, manufacturing in America is not dead. In fact, from 2010 through 2018, US manufacturing added almost 1.4 million jobs after losing jobs for much of the previous 15 years. So we think this trend of reshoring manufacturing is going to continue. It'll come in fits and starts, and it's not an easy thing to do for manufacturing supply chain owners to do, but over time, we do think this is going to come back. And you know, we've heard many economists talk about this over the last several years, and the quip that I love hearing and love sharing the most is, many believe out there that the American Midwest is the next emerging market. And I think you know, our view is starting to shape that. Again, the world that we've seen over the last 2 years, first from a brutal trade war with China, and now this pandemic, which has really interrupted supply chain, is going to entice business owners to act more quickly than we would have thought, where we're going to see this reshoring of manufacturing. And places like Ohio, where I live in Cleveland, in the industrial historical Midwest, are the ones that are likely going to benefit on a relative basis versus the rest of the country, because we do have an unbelievable labor supply in the industrial Midwest, and we do have cheap land on a relative basis versus the coast. So let me stop there. Really delighted to be here. Happy to answer any questions when we get through our prepared comments. Nothing's out of bounds, and I'll happy to answer what's on your mind. So thanks for the invite again.
All right, thank you, Tom. I did get a question, but I think I'm going to hang on to that until after Doug does his talk. So I will pass it over to Doug. I know you've been on a lot of webinars on this topic and work with a lot of companies, so you have some really good stuff to say too. So with that, you can have it, Doug.
Okay, thank you, Angie. Tom, great slides. Just to kind of, there are a couple of things I'll build on off of Tom, but just a little bit of background on me. So I am a 1990 graduate of University of Toledo. So former Rocket, played football and was involved in student government and the fraternity system when I was there. And then got into healthcare, was a healthcare operations and IT exec over at the Cleveland Clinic. And then got recruited to Peoria, Illinois, and then ultimately ended up in Indianapolis and still in Indianapolis today. Got into venture capital about 10 years ago after I was a senior exec at Reebok International when Reebok got bought by Adidas. I was part of the consolidation team, and then ultimately jumped out and went on my own, and have been on my own now for almost 11 years, almost 12 years actually. So invest in startup companies. Interestingly enough, Tom, kind of building off your ideas, one of the reasons that I'm here in Indianapolis and part of the reason that I'm involved in venture capital is the kind of absence of startup capital here in the Midwest. Everyone's very familiar with how many dollars are invested on the East and West Coast, particularly in the New York, Boston, and San Francisco markets or metropolitan areas. But I really believe that there is a untapped potential throughout the Midwest in both venture capital and startup capital. And it's one of the ways that I've made my living the last 12 years. Now, specific to the pandemic, a couple different things that I think are really interesting. You know, Angie, you mentioned I've been on a couple different calls. Some various panelists that I've been on calls with have brought up the fact that, or a couple different facts that I think are really interesting. Number one, the pandemic's liable to last longer than what we expect, meaning that it will take longer for us to achieve herd immunity or to get some sort of vaccine in place that's going to allow all of us to basically feel safe. And I think that's going to be the second thing that we probably aren't necessarily familiar with or expecting. And we're used to using the word confidence and security around financial matters. And I think for the second time in our lives, the first being 9/11, we as a society are going to use the word safe and secure to really, and confidence, quite honestly, to actually talk more around safety, physical safety, and particularly health safety. And so I think all of that's going to tend to change the way that we recover, and ultimately I think it's going to change the future to what we recover to. In many ways, we're already recovering. So several of my companies, I have investments in about 10 different companies. Two of my companies, one happens to be a tequila company, the other one an antimicrobial company, are basically essential businesses. They are fully running. If anything, we're running faster than what we were running before. For anyone who's familiar with stay at home and these types of situations, one of the products that tends to be purchased over and over and over again, of course, is alcohol. And so consequently, the other product that tends to come into fruition 9 months later is childbirth and children. So I would suggest any of you who have that are in the kids business that your time will be coming. So there's a number of companies that are running full bore right now. And I think what we're really talking about is an economy that's kind of split into three different things, or three different lanes, if you will. One is those essential businesses that I will call truly essential. And I was on a panel with the chief operating officer of Newell Rubbermaid, and what he shared was that what they've figured out is that about half their product mix are truly essential products. People want those products. People are buying those products. Their retailers want those products. The other 50% or more of their product mix are not essential. or they had hoped they had made them essential, but they're not, because no one's buying them. And so consequently, retailers don't want to get shipments of them. If anything, they've had to freeze them within the supply chain. So I think it's going to be kind of interesting to see. We're going to have a real kind of reckoning as to what is a true essential business versus what do we like to think is essential, or where have we used marketing in the past to create demand. The other big thing I think we're going to see long-term moving forward is the adoption of new technologies and new processes. Tom, you mentioned the shorting of the supply chain. I think all of us have had some burns over the last 1.5 to 2 years, primarily because of the trade wars, and then ultimately into the pandemic itself. The global supply chain, while allowing us to achieve incredible economies of scale and efficiencies, has a huge Achilles heel, which is that it assumes that global transportation and that global communication will be uninterrupted. And of course, we've seen that to not be true. And so consequently, I think you're going to see a lot of rejiggering of supply chains. I know, because of my apparel company background, a number of apparel companies are already resourcing product from China, Vietnam, and the Far East into Central and South America, because it's easier and quicker to be able to bring product either by land or by train across the border than it is to try to source it by boat and through the ports. So I think we're going to see continued changes like that. The one last thing that I'll throw out is going to be a demographic change. I don't know what the average age is on the call. My grandparents all lived through the Great Depression, and it made a lifetime impact on them and their spending habits and their decision making. I suspect that this is going to have similar kinds of changes in our society, but in ways that we probably don't even understand yet. And what's going to be really interesting is the generation that's going to have the greatest impact on is going to be the Z generation, or the digital generation. I'm a proud member of the X generation. Obviously, the millennials tend to be the Y generation, but the Z generation, which are my kids, they're coming of age in a time when basically they've been sequestered in their homes. They've had to go to prom via digitally. They've had to communicate with they already communicated with their friends and colleagues much more digitally than we ever did. And this has become a way of life for them. So I think applications like Zoom, technologies like telemedicine, virtual contacting people, being able to host a call that pulls in people from around the world 24 hours a day. All of these are going to become things that we are going to begin to accept very quickly into our day-to-day business activity, and is going to cause both opportunities and changes in the way that we do business, in the way that we live our lives going forward. To the point that, yeah, I think the economy will come back, but I think it will come back to a new normal. I don't know whether that normal will be as robust or more robust than where we were as we went from 2019 into 2020. I suspect that, as it always does, it tends to grow. And so I'm obviously very optimistic. I have investments in a variety of different companies and am constantly looking for new opportunities. And so we continue to look for those opportunities. The one last thing that I would add, I was on a call specifically yesterday in Cincinnati, Centrifuge, which is the accelerator in the greater Cincinnati, Northern Kentucky market. And there were probably about 150 startup companies, as well as the innovation officers and others of major employers in the Cincinnati market. And the one major trend that people have seen, particularly in the essential business space, is that innovation is happening in lightning time. Meaning, I'll use Kroger as an example, as the head of innovation was on the call from Kroger. They've had no choice. They basically have had to continue operating their company. They've had to figure out a way to be able to meet day-to-day operational and business challenges. And so consequently, they've seen well over 50% of their purchase volume move online. So consequently, whether it's ordering online, picking up in store, or whether it's ordering online to be delivered to their front door, they've seen a wholesale change in the way that people are getting groceries. and they've had to respond with the technology and with operational change in a way over the last 45 to 60 days that probably would have normally taken them at least a year, if not a couple years, to be able to respond in normal time. And so I think what's going to be really interesting isn't so much that they've made those changes and how all those changes are going to stay going forward, but the realization that corporations, and from small businesses all the way to huge, Fortune 500 companies, have realized that when they want to, they can change very quickly. And so the old rules of test and retest and kind of slowly but surely kind of moving or changing, pushing the big boat around, has, when push has come to shove, they've been able to figure out how to do it. And so I think the rate of change and the willingness to take risks and the willingness to take on new opportunities is going to subtly shift pretty dramatically over the next, certainly over the next 12 months to 18 months, but I think even more long term. And so we're going to end up seeing a variety of wholesale change in a way that we probably don't even understand yet.
Okay, thank you. I had a few questions that either of you could speak to. What do you feel about consumer confidence? When do you think that's going to bounce back? Or do you have any thoughts or perspective on that?
Well, why don't I take that first, Tom, and then you can talk. You can take it from more of an economic standpoint. I think where I would go is that I think, again, historically we've defined confidence as economic confidence or economic security, and by and large, people and demand have been willing to move forward or have been willing to be aggressive when they have felt secure in their financial outlook. I think one of the things that's going to be really interesting to see is similar to after 9/11. It basically took almost 3 years for Americans to get back to traveling the way that they were traveling pre-9/11. But it was really that lack of physical security confidence. Really, it was only constrained to travel because of obviously what had happened with the terrorists and airplanes. I think across the whole economy, you're going to see different behaviors emerge, and a lot of them are going to have and be predetermined by physical and health confidence. And I think the easiest example, Georgia opened up its economy, or tried to open up its economy this week. And if you've done any business down there, or if you've talked with anyone that's there, there's been the number of people that are going into restaurants, the number of people that are going to movie theaters, the number of people that are even leaving their houses really isn't that much different than the rest of the country, which is still sequestered. People are voting with their feet, and they're not going anywhere because they don't feel confident, they don't feel secure. And so I think one of the things that is most important, what we're going to see is the way our economy is built. We're really driven by the individual. The president, the federal government, the state government, the county government, all of them can say, hey, go out, spend your money. But ultimately, it's going to be people who make those decisions, and those individuals aren't going to make the decisions that they don't think are in their best interest. And so it's really going to take people feeling confident with a particular company, with a particular product, with a particular activity before they're going to resume doing it. And so I think little things like, I was on another panel the other day, and we were talking about retailers and how do retailers get people to come back to their stores. Something as simple as making sure all employees are wearing masks, but something as silly as drawing a smiley face on the front of those masks, so that people, the consumer, can feel confident that you're taking physical security seriously, but at the same time, you're not putting people off by a harsh new standard, right? And so I think there's going to be, we all are craving human contact at the moment, but people are, that human contact's an economic transaction. People are not going to be willing to put their physical health at risk or the risk of their family or the health of their family at risk without having some confidence that you as a vendor, you as a customer, or you as a retailer, you as a provider have taken their health seriously and are looking out for their best interests. What do you think, Tom?
I think that's really well said, Doug. I agree with all of it, really. It's going to take time. You know, from an economic perspective, the confidence of the U.S. consumer has always been correlated to the job situation and the business owner situation. There's lots of CEO surveys that give you kind of a look into the mind of decision makers at small, medium, and large-sized businesses, where their heads are at. And typically when those surveys are rising, business owners are investing in themselves, investing in CapEx, capital expenditures, and that's just a fancy word for saying a business investment. And right now, all of these figures are depressed, as you would expect. So from an employment perspective, rough numbers, and I always try to contextualize things with some data. It really just helps me think about it. In February, prior to the virus, there were around 165 million people in our workforce, and 5.9 million of them did not have jobs and were looking for jobs. That translated, again, 5.9 out of 165. That's about a 3.6% unemployment rate. That was the lowest unemployment rate since December of 1969, lowest in 50 years. So we came into this, as I mentioned, from a position of strength. What we know over the last 30 days is that unemployment claims by U.S. citizens is right around 30 million jobs. So if you parse that out and add the 30 million theoretically temporarily lost jobs, maybe permanently lost jobs, furloughed jobs, the unemployment rate is going to look like, again, 5.9 million at the end of February. People were looking for jobs out of 165. These 30 million jobs, that would bring you to about 35.9 million jobs, or job seekers. If you can extrapolate people that are applying for unemployed benefits, that they will be now looking for a job. 35.9 over 165, which is the people in the workforce, that works out to about a 21.7% unemployment rate. Now, the numbers are calculated a little bit differently when we get the official statistics from the government, but we are going to go more or less from 3.6% unemployment in this country. Let's call it 15 to 20% when the numbers come out here in about a week. That's unbelievable. To put that into context, in 2009, the highest our unemployment rate got was 9.9%. And in the Great Depression, the highest our unemployment rate got was 24.9%. So if we're in the 15 to 20% unemployment, again, we think it's going to be short term, but it tells you that consumers are going to be trying to survive, and consumer confidence is going to be very low. And as businesses open up, I completely agree with Doug in that people are going to be cautious in the way they spend their money. So I think it is going to take time for the jobs picture to change. I think it's going to take time for business owners to feel more confident in investing in themselves, and that is all going to depress economic output, and it's going to make our recovery a little bit longer than normal. But to put this in perspective, we're trying not to be too negative. We think we've kind of ran some numbers at the most affected industries that are likely to change in one way, shape, or form. We looked at hotel and travel. We looked at airlines and cruise lines. We looked at restaurants and bars and eating out. And we looked at sports and concerts and movies. And those kind of four main categories make up about $720 billion in spend a year from consumers. On an annual basis, the US consumer spends about $8 trillion. So 720 out of 8 trillion is about 9% of our economy. We think is going to be really, really impacted by the areas hardest hit. Again, travel, airlines, cruise lines, restaurants, bars, eating out, sports, concerts, movies. So now you start to try to extrapolate, okay, so if 9% of our spending on an annual basis, and it's important to put that in perspective too, our economy is a consumer-based economy. 68% of the U.S. economy, U.S. GDP, is is driven by consumer spending. People like us on this line that either have jobs or are business owners and are earning wages or earning profits and spending those profits or wages on stuff. So 10% really going to be in industries. Then you start to make some assumptions on post travel, airlines and cruise lines, restaurants, bars, eating out, sports, concerts, movies. What does that look like? And maybe you get 50% of the pre-virus, maybe it's 25%. But what we hear in the financial press is that to be a complete and utter disaster for the foreseeable future. We don't believe that. We don't believe that. Much of the consumer spending that goes on in this country is on housing, food, personal insurance, healthcare, and the like. That makes up the overwhelming majority. These consumer discretionary, hotels, travel lines, restaurants, sports, it makes up around 9% of our overall spending. And let's say half of that comes back, then we're looking at a 4.5% decline in overall consumer spend as the unemployment rate starts to come back down. Again, weeks, months, quarters, many quarters and years like we saw coming out of 08 and 09. So that's where we are. We largely agree with Doug in that consumer confidence is going to be the key, but we are not believing that it's going to be an Armageddon where we are going to be digging out of this hole for the next 4 or 5 years. We're not there. I hope that made some sense.
Hey, actually, Tom, just to kind of piggyback off your last comment there, I agree with you wholeheartedly. I think there's one likes to kind of think about this idea of pent-up.
Yeah.
And I think there's a couple different things that you have to understand about pent-up demand. It's primarily a service or a service product. I really need a haircut, right? Right? But I'm not going to get the 3 haircuts that I would have normally gotten over the last 2 months, right? You only need to get your hair cut once. And so I think now my wife and I are, both of us kind of like to cook, but we've had to cook every day, right? And so other than when we've gotten takeout, I have a feeling we might go eat out, for the next 2 weeks after we're allowed to, once we have confidence that the restaurants are fully operational and safe. So I think it's going to be really interesting by industry. Some of this pent demand, some are going to have pent-up demand. Others, just by the nature, you're at 12 massages in one. So I think there's going to be certain other areas where people will have idea of pent-up demand. Another big thing that I would throw out is there's definitely going to be winners and there's going to be losers. And the winners are going to be folks who take their customers' needs and desires and understand them to be essential. And security and safety is going to be one of those, right? And so, one of the companies that I have investments in is an antimicrobial company. We're basically selling as much product as we can make right now because people are using that product. It's been proven to be, effective against coronaviruses. And so consequently, they're able to then put a little sign up in their window that says, hey, we've been treated with this particular product and thus it's safe to come here. And that's going to be a flow changer in terms of how consumers make decisions. And so there's going to be winners and there's going to be losers.
Okay. So on the topic of specific industries, what are your thoughts on real estate and specifically commercial real estate? What does that look like after this?
Wow, that's a great question.
You want me to start?
Yeah, go ahead, Tom.
So I think it's too early to tell is the honest to God answer. We've been having this conversation. I think this is one of the potential losers. So what we've noticed from our organization, and it's anecdotal, is that I work for a big regional bank, and we, as a workforce, 15 to 18,000 employees, the overwhelming majority of us have now migrated to home offices. And certainly the first few weeks, there were some hiccups here and there, but we, as a company, have been able to work from home, really no problem. I've been speaking with lots of people in the investment business, lots of people in the banking business, lots of our clients, lots of our clients who are business owners, and I'm hearing very similar conversations that, you know what, we can do much, not all, we can do much of our work remotely. And I think habits will change. Habits will change likely slowly. Habits will change slowly and in fits and starts. But there is a very real possibility that large corporations in particular will reduce their commercial real estate footprint and have more mobile employees. And this has big implications for commercial real estate in city centers and the cores of large and mid-sized cities throughout the country. It's too early to tell, but anecdotally, we think commercial real estate may be one of the losers coming out of this. But again, that's one of the things we've been talking about. We're kind of taking a clue from financial markets, and you can see commercial real estate related organizations that are publicly traded certainly have not been doing as well as some others. And you look at some of the real estate investment trusts that are publicly traded that have commercial real estate holdings, they have not been doing as well either. So there is an ongoing debate amongst investors how commercial real estate will change, if it will change, but the early signs are not great. And that's kind of the honest answer where we are now. It depends, but it's a potential one of the longer term losers, particularly in city center cores.
If I could just tag on to that, actually, I would just say that there's going to be winners and again, there's going to be losers. I can tell you from two of my companies, to your point, Tom, we've actually ended leases in suburban office space because we don't need it. We've proven that we can operate basically with a virtual office and we can operate just fine. So why are we paying for office space we don't need? So I agree with you wholeheartedly. The suburban office real estate market, I think, is going to fundamentally change. But I think there's also potentially winners in the warehousing, distribution, and manufacturing space. I think the idea of bringing operations back into the U.S., particularly into the Midwest, storing more inventory, storing more product that's closer to market, trying to shorten the supply chain, and to pursue local manufacturing, local sourcing of product. I think that was a trend that was already happening prior to this. I think it's going to do nothing but grow. And I think there's a subsequent trend that's also going to impact it, particularly in the food supply and particularly in the healthcare space. Folks are going to want to know the product that they're consuming, where did it come from? And so the easiest way to provide that information is to shorten the supply chain geographically. And so one of my companies is think of it as a farmer's market online that has, well, we're here in Indianapolis and we're in Cincinnati, we're in Evansville, and we're in Fort Wayne, probably growing to Toledo at some point. But people want to buy local. They also want it to be as convenient as going to their neighborhood Kroger or whatever grocery store that they're used to going to. And so I think there's going to be this push for new delivery mechanisms, new purchasing processes, but all of that's going to then have impact on real estate long term. And I think one of the potential winners in all this will be distribution centers, warehousing, and manufacturing space, not only in major metropolitan areas, but distributed kind of throughout the Midwest. Because again, that advantage of cost difference that Tom mentioned earlier.
Yeah, well said. I would say one of the other winners, if I could just add on to that, is well, winners and losers, and that's going to be on the I guess the housing side. So if you do see a more virtual office worker, typical, historical office worker, that person doesn't need to live close to wherever their employer headquarters is, whether that's, in the city center, inner ring suburbs. That could mean, these employees can move to outer ring suburbs, but I also think it has the potential to add more migratory power to the individual. And so I think that might be a negative for the Midwest, in that virtual employees who frankly don't love Cleveland winters, and yeah, they could choose to kind of work remotely, maybe in Hilton Head, South Carolina. And so this may be a grand population move that's already been happening for the last 25, 30, 40 years. It might be exacerbated by this if there's more mobility in the hands of individual employees. So that could be both a winner and a loser for private home real estate.
Or on the flip side, maybe some of the people who have decided they no longer want to be in the overpopulated cities or drive those long commutes or pay those high rents might want to move to the Midwest. So
completely,
maybe we could see that happen.
Hey, Angie, if I could just add on to that. I mean, so there's been a major effort here in Indianapolis. We've called it the Project X expats, and basically it's been a big push here in the central Indiana market to try to get folks who were from originally Indiana or went to school at one of the universities here in Indiana that then moved to the east and west coasts, primarily in the computer science and technology space, to come back to the Midwest to then raise their kids. And we've found phenomenal success over the last almost 10 years. The proverbial person who wakes up in Manhattan or in downtown San Francisco and is paying a couple $1,000s a month for a studio apartment and can basically buy a house with 5 acres of land in central Indiana. And we've been able to get that person to move home. So I think, Tom, to your point, it's going to be really interesting to see, and I think that's going to be one of the generational things that happen. Does Generation Z decide to not live in, because right now they're not buying anything in the suburbs. They're living in the urban core, and that's part of the reason that you're seeing a lot of the reinvestment in housing in downtown urban cities across the United States. But do they end up deciding to live in small towns? Do they end up deciding to live out on farms in the country? And I was on a different panel with a senior exec from Tractor and Supply Company, the retailer that has really become, they like to think of themselves as the suburban farmer market, but they're really excited that there's going to be a potential migratory move out to what they call gentleman farms, the 5 to 10 acre kind of plots of land with a house in the middle of it that would have a beautiful home office, that would have Wi-Fi and internet capability, and basically people can live wherever they want based on mountains, based on climate, or based on space and expense.
So while we're on the topic of industry specific, I have 2 kind of other questions on winners and losers we'd like to get your thoughts on. One is the construction, a bit about the housing, and then where in terms of manufacturing and warehousing, but the commercial, industrial, and or residential, do you see those as winners or losers? And the other is the mining industry and the oil industry. We've got 3 in our area who are large employers of other small businesses and contractors. Where do you see that going?
Tom,
yeah, let me go. So let's talk about energy first. So anybody that's following the energy markets has seen the price of crude oil go from, mid-50s to under 10 on WTI, and there's some funny stuff going on with the front month futures, but let's leave that for another day. So there is a global glut of crude oil on the marketplace. There's a lot of supply. On top of that, now following the pandemic hitting China and Asia and really going through the rest of the world, there's been a big decline in demand. And that's really the reason. So you had too much oil in the marketplace, and then you had too few people needing that oil. That's really what has happened over the last 3 months. You had WTI, like I said, going from 50, 58, 55, somewhere in there to 15 or wherever it is today. Historically, so let's say this first. It is in the very near term, the energy patch, the shale patch in the U.S. Is going to get crushed. There are going to be very distressed companies. Some will make it, some will not. We expect massive consolidation from the big integrated companies, your Chevrons, your Exxons, your large global multinationals that have deep pockets buying these distressed companies. That will help take some of the supply off of the market. It will help, typically, the way oil investors have always said it is, the cure for low oil prices is low oil prices. So as oil prices go down, you see less exploration and production. You take rigs offline, you take supply offline. That typically leads to a little bit higher prices. We think this is going to be a very messy situation over the next several quarters and maybe years. It doesn't mean that this is going to last forever. If you look at 1 and 2 year futures contracts out for WTI, they're at multiples of where they are today. So at least investors believe today that prices, after we get through both the demand shock due to the shutdown of many global economies from the virus and the supply shock, frankly, the US has recently become oil independent for the first time in 40 or 50 years, and you have Saudi Arabia and Russia in particular having too much supply on the market. These imbalances over time will work themselves out, and our expectations, you'll see higher oil energy prices over the next several years, but not before a lot of pain. So in the near term, I would suggest that the refiners, who are in a little bit better place than some of the exploration production companies, they will feel this pain. But longer term, I think it would be foolish to discount their prospects of growth. But those growth prospects have certainly been interrupted, and it's going to be in a return to growth in fits and starts over the next several quarters and potentially years. So for now, as an investor, it's unclear how this is going to shake out. Our expectation is that there will be lots of bankruptcies in the mid and small tier shale patch energy companies. It's probably going to lead to a lot of consolidation, and the companies that have the strongest balance sheet will likely be the winners, at least in the near term. Longer term, I think WTI is likely to grind higher from these very, very low levels. So that's the thoughts there. I forgot what the other questions were. Were those real estate type questions?
Well, it was construction.
Construction.
Yeah, but
go ahead.
Hey Tom, let me jump in on the energy first before we then go on to construction. So I think one of the things that we're going to see, again, more of a lifestyle kind of decision that ultimately is going to have a pretty big economic impact long term, is going to be off the grid and kind of self-sufficiency. So, I think one of the things I think we all knew, but we didn't really understand, is that the average commute in the United States was approximately about 55 minutes, right? I think for those of us who've been fortunate enough to be able to work directly from home, not as an essential business, we suddenly have captured that extra hour in our day, right? And I know for me, initially that was really nice, and then it quickly filled up with other activities, right, and other business. And so I think it's going to be really hard. People are not going to want to give that hour back. And so I think that's going to further incentivize, if you will, the work from home desire. And I think it's going to have a long-term impact on the amount of gasoline that's consumed. Because obviously, if I'm not sitting in a car driving to work, if I'm not riding public transportation, if I'm not commuting, then that's a whole level of energy consumption that I'm not having to deploy, right? I think the other thing that's going to be really interesting to see, and this is going to probably be more of a generational issue, the explosion of the number of shows, both online and on HDTV and other networks, the off-the-grid kind of lifestyle. My kids are like all fired up about it. I grew up on a farm, moved to the city to pursue my future and to pursue glory. Would love to get back out into the country at some point, but haven't figured out how to do that yet. But my kids think that they're going to go live in a log cabin, out someplace and have either wind power or photocells on their roof, and are going to live sustainably, right? So now some of that, is the romance of teenagers, but I suspect that my kids aren't alone. And so I think it's going to be really interesting to see over the next 20 years how our energy consumption habits change, as well as obviously the lowering cost of alternative energy and other kinds of energy sources, battery technology, et cetera, right? And so, and not to mention, you're going to have a whole cadre of people out of this situation, out of the pandemic situation, that are going to be survivalists, right? And are going to end up setting themselves up and are going to be prepared for the next pandemic or the next doomsday or whatever you want to call it. So I think all of that's going to create a long-term change in our energy consumption habits. And I would not necessarily be investing in the futures of oil long-term. Now, you want to talk construction, Tom?
Yeah, I think so construction, I think, will come back, and it will follow the changes that happen in our economy, right? So the construction projects that happen, and construction is such a broad swath covering just about every industry that's out there. I think if you see migratory patterns for individual housing change, you will see the home builders, who are essentially construction companies, follow those patterns. And whether it is moving out of cities to more cheaper Midwestern cities or small towns or farms, or if you see a migration pattern of people from inner city cores out into southwest or southeast areas that are better for a weather perspective. I think it's all going to change. It all depends on the migratory patterns of individuals, and I think the home builders and other construction will follow that initial trend. And then on the construction, again, I think one of the big things that we both talked about is we do think that there's going to be a reshoring or onshoring of supply chains, particularly in manufacturing. And I would expect construction to be a big beneficiary of that. Again, but that's going to be changing or following patterns that develop from the disruption that's happening now. So if you see large multinational corporations bringing supply chains home, or frankly, even mom and pop shops that were sourcing parts of their businesses from China coming back to the industrial Midwest, you're going to see the need for construction companies to go help those manufacturers build plants, build property, build equipment. And I think that is betting against the reemergence of construction. It might look a little bit different than what we've seen over the past 10 years. I think that would be a bad bet, because I do think that will come back as these changes happen over time.
The one thing I would add to that question is I think it's going to be really interesting to see how home remodeling goes. I'm assuming everyone who's been now, has been sequestered has figured out the 2 or 3 things they'd love to change about their house. The question becomes, A, do you make that investment in your house, or do you go buy the next house? And I think it's going to be really interesting to see over the next 12 to 18 months how those, that question gets reconciled for a majority of the people.
Thanks. I definitely have a lot of those projects that I'm staring at, and as soon as we can get out and buy things and get going, we will address those. I'm going to shift a little bit. This question was directed at Tom, but feel free to jump in too, Doug. Do you have any concerns over the massive increase in federal debt?
Yes. The end. No, just kidding. So in the short term, it was necessary. So think of it as a patient that's extraordinarily sick, and you have to do everything in your power to keep that patient alive. And essentially what the government has done is build a bridge for, this is essentially a man-made recession. The governments in Europe, Asia, and the US by fiat have essentially shut down the economies over the course of the last 2-3 months. By doing that, it was really necessary to build this bridge to help the individual, the consumer, make it through a time where their pay was interrupted. And I think that's what the stimulus has been doing. So keep the patient alive while we go through the worst of this downturn, while we go through the worst of this recession. That was necessary, in our opinion, in my opinion. And we're going to reap the benefits from an economic perspective over the next several years because of the stimulus that is going to entice entrepreneurs and risk takers to grow their businesses as things slowly return to normal. But we've got a problem longer term, and there's no doubt about it. If you look back at history, going back hundreds of years, anytime that governments have put this much debt on their balance sheets as a percentage of GDP, it typically leads to inflation, and inflation is it's awful to financial markets. It's a disincentive as the cost of capital rises for business owners, entrepreneurs, risk takers to take on debt and try to build their business. That's your risk. So in the near term, I think it's like a patient who is about to be intubated. They're doing everything they possibly can by adding the stimulus, the debt that they're doing to get to that bridge to where the economy will open back up, consumers will re-engage in their jobs, will have additional spending, and where business owners will start to feel a little bit more confident about their prospects. They'll have very low interest rates, they'll have very low inflation, and over the next many quarters and probably next several years. The risk, and it's a big risk, is what does this look like in 2 to 5 years' time? What does inflation look like in 2 to 5 years' time? Because historically, when governments do this, it typically leads to inflation. And then the cure for higher inflation is much, much higher interest rates to cure that ill. And that will then put us back into a recession. The only time that it really hasn't happened, there's two examples. It's Japan in the 90s and going on to today, where that government added a massive amount of stimulus through quantitative easing, very low interest rates. Their inflation situation never came about. And frankly, it's the US after the financial crisis, where the US lowered interest rates to zero, began buying bonds and initiated quantitative easing. And we did not see the inflation that many, many people predicted. So it's not a guarantee that you'll see this big inflationary spike, but that's the risk that most investors are talking about today. For the near term, let's call it the next 2 months to 2 years, the government had to do this to get the economy back up and open and running, but the risk is longer term, whether this massive amount of debt leads to inflation, and that will again kill the economy at some point in the future.
Let me just, Angie, if I can just add to that, I think Tom's absolutely right. I mean, I think first and foremost, I think we all understand that there was no choice, right? The patient needed a transfusion, and so we transfused them, right? But I think there is a real big question, and I think your two examples, Tom, are great examples. The other thing that has been oftentimes used to offset or to prevent inflation coming from liquidity has been innovation. And I think, both coming out of the 2007, 2008 time period, and certainly Japan, modern day Japan, we've seen this ability of both the American economy and the Japanese economy to evolve into new structures that allowed it to achieve tremendous gains in productivity and innovation. The real question is going to be, what impact do we see coming out of this pandemic in terms of global communication, global collaboration, and then how do supply chains shift? That are they able to continue to support the debt load that's not just in the United States? Unfortunately, this is happening globally, right? As everyone's tried to support their economies. And so ultimately, right now, the United States is protected because there's so much global capital flowing into the U.S. At some point, the assumption always is, and the economic models are always, that the amount of capital is somehow finite in the world. And I think we're reaching a point where we're going to begin to test that question.
Yeah, well said.
So on that topic, are you concerned at all about the mid and long-term impact that the increased federal spending will have on taxes?
Yeah, I mean, I think that dovetails into the last question, certainly. I should add one other thing. So I think Doug's point on innovation is part of the reason why we have not seen the inflation that was expected either out of Japan or the United States in the two examples that we talked about. I think that is going to continue going forward. The one thing that might not happen is the last 30 years, we've seen globalization. We've seen this optimization of balance sheets, putting your supply chain in the very lowest cost area possible. And that's also one of the big reasons why we haven't seen inflation, right? So you've essentially seen corporations maximize their profit margins by putting their factories and supply chains in places where it costs the cheapest. And you've heard Doug and I both talk about for the last hour that we think there's going to be a re-onshoring of manufacturing. And if that happens, that's essentially the opposite of globalization. And it remains to be seen whether that will cause profits to decline or not. There's a great study out there by the Boston Consulting Group, and they've been doing it, I think, since 2004. And the study is titled something like Global Manufacturing Competitiveness. And when they first started doing it, China had basically a 20 percentage point increase or lead on the United States as far as total costs to have a manufacturing plant in China relative to the US. And as we got to 2018, that 20% differential for China whittled down to about 5%. So the competitiveness of the US when it comes to manufacturing, it has gotten a lot more competitive over the last 25 years, but it's still not quite as cheap with your all-in costs to have a manufacturing plant in the US than it is in China. If you believe this study, and there's a lot to be believed about this study, it's probably, when you're talking about labor, the cost of your plant, currency, energy, all of these costs go into having a manufacturing plant. It's still a little bit cheaper in China, but I think what we've seen, again, our view is that these manufacturing supply chains are going to be re-onshored. So the question then is, will profit margins decline? If profit margins decline, the natural offset for these companies will be to increase prices. Higher prices over time would lead to higher inflation. So that is the real question that's going on. That's the question between globalization and I don't know what the right way to say it, but bringing things back home, populism, nationalism. There's a question on how that will affect inflation longer term.
Actually, Tom, that's a great point. And one thing I would kind of throw out to folks, there's a great, the RAND Corporation is actually doing a number of different studies right now around how they think coronavirus and the pandemic will impact globalization. And I think one of the more interesting ideas that they have is that you're really talking about two different types of products. You talk about commodity kind of products that are, sold at the lowest cost ultimately, and you have your, call them premium products, call them your preferred products, whatever you want to call them. Basically, they tend to be bought, and when they're purchased, the desire of the consumer is to better understand the supply chain and how they themselves were produced, right? And so you can make a substitution in your product mix where you're buying fewer of the premium products instead of buying more of the commodity products in the same product mix. And so I think that's going to be one of the interesting things as we go forward. I think this reshoring is going to happen, but I don't know that it's necessarily going to result in price inflation in the way that we would expect it to, because I think the economy is going to start to prefer more of a premium product that's locally produced than the commodity product that they would have otherwise purchased.
Thank you. I am going to ask Paul Schmidt to unmute. He had a question, and I think it would be best maybe if he just asked it directly. Paul? You have to unmute first.
Hey guys, quick question. You guys are talking about consumer spending, and I'm looking at my checking account, and one of the biggest expenses I have in my life is automobiles, cars. And the auto builders have laid off an awful lot of their employees and held off on building. What do you guys think about all that kind of industry? Thank you.
Well, Tom, let me take our first stab and then hand it over to you. But I mean, I think there's, whether it's the ride-sharing companies, whether it's the change that you've seen in the car rental companies, Enterprise and Hertz and others. I think this idea. I have a 16-year-old in my house, and when I turned 16, I had already saved and scrimped and went out and bought a car the day after my 16th birthday. She has very little interest in buying a car. And so I think this is going to be one of the demographic changes that we see. I don't know that the same desire is going to exist to own an automobile and in the way that we're used to in the United States. And I think that's going to change the concept of automobile ownership. And ultimately is going to have a much bigger impact on the automobile industry and obviously the automobile manufacturing industry.
Yeah, I don't have anything clever to add there. I think it depends on consumer preferences. Old guys like me are going to buy cars. I can tell you that. I know that I will be in the cohort that will continue to want my individual freedom to have my own car to go to the places that I want to go. But I think it's more important that the millennial generation behind me, who, by the way, is going to be, I believe it's now the largest cohort population-wise in the United States. It depends on what their preferences are. So if they are comfortable ride sharing, if they are comfortable taking public transportation or other means of not owning an individual car themselves, I think that is, it remains to be seen, but the trends early are that the way people younger than myself consume that product is potentially changing and potentially changing in a big way. And then that will force the incumbent automakers to make decisions on how they're going to run their businesses going forward. And perhaps they diversify business lines out of individual autos and trucks into other things, like what we saw GM do with, just in time making ventilators. So I think because of the 100-year history of manufacturing excellence, by and large, the incumbent automakers have, there's lots of other things that they could manufacture to cure new demand that's out there. But your specific question is, it depends on the consumer preferences of the cohort that is younger than I am. I'm 46. I'm going to be buying cars, my guess is, till the day I die. But it depends on what my kids and their kids do going forward. And the early signs is that, at least in the last 10 years, there was a big migration from millennials to live in the city centers and not own cars. The question will be, does that change? Because we had some questions about what does private home ownership looks like? What do geographic areas where people want to live look like? And what are those transportation needs going to look like? And I think that's still undefined, but the early reports are I would agree with Doug, and that consumer preferences of the millennials are potentially changing, and potentially changing a lot. That has big implications for the big automakers.
There was a question to something that Doug had said earlier. You talked about your experience with the incubator in Cincinnati that had 150 startups.
Uh-huh.
Okay. What would it take? Now, we have a few incubators in this area. I know specifically we have a few of them at the university. The question is, what would it take to get something like that, something to that scale, started in this area, especially given we're talking about that there might be some more opportunities for reshoring?
Well, it's interesting. So just to be clear, so I'm involved in a number of different incubators. Centrifuge was the incubator in Cincinnati. I'm also involved with a couple incubators that are here in Indianapolis. But I'm also involved and served actually as a judge for the Launchpad, which is a University of Toledo sponsored incubator there on the campus with the College of Engineering. I was a judge at their pitch and pour competition last October, where they had 4 or 5 different companies kind of give their pitch on their business. But, I think what's interesting about, let me talk specifically to Cincinnati, because I think they, probably more so than just about anywhere, have really been effective. The major employers in Cincinnati, meaning Procter & Gamble, GE, and Kroger, got together and basically launched out of, it was originally actually located in a P&G building, that the Centrifuge incubator, probably about 10 years ago, I would guess. I could be wrong on that date. But, and they've been extremely successful, catalyzing both, they have an affiliation with the University of Cincinnati, they have an affiliation with Xavier, I think they have affiliation with a school in Northern Kentucky, and both taking kids that have an interest in starting their own companies, that are studying entrepreneurial sciences and others, and then leveraging their efforts as well as community support to really start to create an ecosystem. And I can tell you that is the key. What's interesting, we were just talking about the automobile industry. As an investor in the Midwest, one of the things that I have found is each of the different municipalities, if you look at the Midwest as a whole, take Harrisburg, Pennsylvania, and then west out to Omaha, Nebraska, and then from the Ohio River north to Minneapolis, Minnesota, you'll find there's about 28 major metropolitan areas in that geographic area. What's interesting is each one of those metropolitan areas, with probably the exception of Chicago, are known for a particular type of business. Here in Indianapolis, we have Eli Lilly, and we have Roche Diagnostics. So we have a lot of folks in the kind of bio/life sciences, and we have a few software companies that developed, originally it was software artistry and then ExactTarget. And so this whole idea of email marketing and marketing technology. If you start a company, if you have a consumer packaged goods business that you want to start here in Indianapolis, this isn't a particularly good place to start it because nobody here knows that business. Obviously in Cincinnati with Procter & Gamble and with Kroger, you have lots of people who understand this consumer packaged goods business. And so what I've kind of seen is throughout the Midwest, each different metropolitan area tends to develop its own area of expertise. Obviously Toledo, and Detroit are known for their manufacturing, are known for automobiles, or known for their engineering. Glass science and glass engineering, because of Owens, Illinois and Owens Corning. I think it's how do you leverage that expertise that you have in your local community. And I think that's one of the things, that, Angie, you could probably talk a little bit more about specifically to the Center for Family Business, but also, the School of Business and Innovation itself. But I think it's a great idea, and it's a great way to seed and feed companies. And it's a great way to retain talent. And so that's been one of the things that we've had to do here in Indianapolis or in Central Indiana, is really try to recruit and retain talent, so that out of that you then beget a whole family of startups in a new economy.
Great. And yeah, you mentioned we do have the incubators. They do the pitch and pour. It's fabulous. I know the College of Business does some business plans, competitions for the students. There are, we have a whole tech transfer office that will help if you have an idea, connect you with, maybe someone in the engineering or someone in the business or biology, depending on what expert you need, what lab facilities you need. And I'm thinking that might be our next webinar, because we do have a great incubation program. And I don't know that a lot of our members know about that. So that's on my webinar list for next. So thank you. Chris Anderson had a question about the labor force. So if you want to unmute and go ahead and ask your question, Chris.
Thanks, Angie. There are two things I heard you talk about: onshoring, and then as I think about the supply chain, particularly going to retail and the whole Amazon effect, I'm just wondering about I'm assuming that more is going to go to Amazon, and I'm assuming a lot of retailers are under a lot more pressure now as a result of this. So my question is, what do you see as being the impact of onshoring in terms of our ability as a labor force to keep up with that, as well as what I sense is there's a disconnect between geographical labor needs and where the labor force is today, particularly as it relates to the distribution system.
Well, I'll take that question first, and then Tom, you can jump in after. I think it's a great question, right? And I think there's a lot of people who are trying to understand how onshoring is going to happen. And let me be very specific here. I don't think I'll use apparel as a great example. I don't think cut and sew operations are going to return to the United States. One of my companies, we're involved in producing masks, face coverings, and initially we were treating them with antimicrobials so they could be used in a pinch in the hospital setting as PPE, right? And so I think there's a great example where what we've learned as a people and as a society is that there are an incredibly small number of true cut and sew operations and operators in the United States. The vast majority of clothing that we wear and that we buy, whether it's at Amazon or Walmart or wherever we buy clothing, or even if it's polo, are those cut and sew operations are elsewhere, right? They're offshored. I don't think they're going to be coming back. I don't think Hanes or Fruit of the Loom or any of the big sporting goods brands are going to be moving their operations domestically because the labor cost of cut and sew, the preferences are too great offshore. However, I think because of equipment automation, multi-headed sewing machines that can automatically sew, I think what you're going to find is there's going to be the development of premium products that are produced here domestically that are going to, but are going to be highly automated. And so consequently, what you're going to see is the labor that's needed to run that factory is going to be much different than the labor force that was needed to run that same factory 20 years ago. And I think you're going to see the same thing in distribution. The use of robots, the use of automation, the use of material handling equipment is going to dramatically change the need of employees and the type of labor that you need in a modern day warehouse. And you certainly see that in the Amazon warehouses. We have a couple million square foot Amazon warehouses here in central Indiana, and they each might have 100 or 150, maybe 200 employees max, because people aren't handling boxes anymore, right? They have machines to handle all the boxes, but they need somebody to run the machines. And so the training that you need, the technical background that you need in order to serve in any of those roles is very different than the historical warehouse worker. I think you're going to see, when we talk about onshoring, I think it's going to be onshoring of capabilities, but I don't know that those jobs are going to be the same jobs as what they were when they left. And I think that's going to then require, I don't think it's going to be a change in labor. It's going to be a skill set change. And I know there's a major effort here in Indiana using the state community and technical colleges to prepare folks more for those robotic support jobs, right? Being able to build and work on robotics, working on automation, working on material handling equipment, those jobs of the future. And I know back when I was at Toledo, a lot of those programs were over at the Community and Technical College. I think there's an opportunity for organizations to be involved in the training and the preparation of those employees or those future employees. And I think that's going to be what's really onshored when I talk about onshoring.
Great. Well, that brings us to 10:30. I think this has been absolutely fabulous. I've gotten probably 6 pages of notes over here. I want to thank you, Doug. Thank you, Tom, for joining us. Thank you for sharing your insights and your expertise. We very much appreciate it. Just to let the group know that we did record this, and we will put this on our website. We'll send an email out to those that are registered and the participants that we have. So we will send that out with the link, and feel free to share it with anyone. If you have any other topic ideas, what we've been doing at the center, I mentioned earlier, is just trying to be responsive to our members. If there's something you want to know about, if you want some expertise on, you want to just get with other members to talk about, let us know. We'll put something together. That's it. Thank you, everyone.
Hey, Angie, I was just, thank you very much for including me, number one. Number two, if we didn't get to somebody's question, or you guys think of a question afterwards, feel free to forward it to Angie. Or you can reach out to me on LinkedIn, and we'll be happy to follow up with folks.
Great. Thank you. Thanks, Doug. And thanks again, Tom.
Thanks so much for the invite. It was great spending time with you all. Take care.
Take care, guys.
Thank you. All right, bye, everyone.